Good morning, everyone, and welcome to our Capital Connect webinar. I can see there's quite a few people joining. We'll just wait 30 more seconds for a few more people to join before we get started. What a beautiful day we have out there in the sunny southeast Queensland. So I hope everyone's got a beautiful day where they are today. All right. We might get started and everyone else can just join as they come along. Welcome, and today I'm delighted to be your host. I'm Julie McCarthy from Capital. I'm the Senior Community Relationship Manager and fill the role with some business and systems innovation here at Capital. Today we have two privileged speakers, being Craig Stanley, National Business Development Manager at CHU, who will share his wealth of knowledge about the current insurance market. And then we have James Nickless, a partner at Chambers Russell Lawyers, who will provide some invaluable insights into body corporate maintenance. Each presenter will speak for approximately 20 minutes to captivate your attention, deliver their expertise, and then we will have a quick question and answer after each presentation. By the end of our webinar today, we aim to equip you with comprehensive understanding of the current insurance market, essential topics such as insurance renewal processes and the significance of insurance valuations. We'll underline the vital role the body corporate play in maintaining roof structures, highlighting the value of proactive maintenance and averting potential issues. At Capital, we're passionate about working with our owners to create happy, healthy and harmonious communities. Before we jump into the webinar, I'd just like to go over a few items of how to participate in today's event. We've got a screenshot coming up. Which just shows you the Zoom interface. If you're using your computer, it may be a little different if you're on a mobile device, but as you can see, you've got the audio setting, raise hand, question and answer chat, and the leave meeting function. You will have the opportunity to submit questions to today's presenters by typing into the question pane on your control panel. And we may see in your questions during the presentation, and we'll keep your submitted questions anonymous. Today's webinar is 1 hour. It will be recorded and posted to our YouTube channel, and you'll also receive an email with the recording. Following the webinar, as always, we seek your feedback, and if you leave your feedback by 5 p.m. Wednesday, 21 June, you go in the drawer to win a $100 prepaid Visa card, and that will be drawn on Thursday. So the overview of today's presentation. We'll get started with Craig Stanley, an enthusiastic, customer-centric, diligent and detailed National Business Development Manager with 25 years experience in the insurance industry, including underwriting of various products and broker distribution management. Craig has acquired extensive technical knowledge across many lines of insurance, including strata insurance, both residential and commercial insurance, business packages, ISR, and financial lines products. He delivered industry presentations to brokers on a range of topics, including risk appetite, management liability, privacy, security, and more. Let's welcome Craig. Thank you, Craig. Welcome, and we'll let you proceed with your presentation.
Sorry, I was muted. Thank you very much, Julie, for the kind introduction. I really appreciate it. All right, we might be able to go to the next slide. Yeah, we might go to the next one again. Right, thanks everyone. Pleasure to speak with you today. And today, really, we want to talk about the state of the insurance market, and I guess it probably comes as no surprise that the premiums have been increasing, but I really want to tell you why they're increasing. There's also an issue like underinsurance at the moment. So I want to talk about the importance of valuations, so that might help solve some of those issues around underinsurance, because they're you know, it's obviously not good if your building's underinsured and there is a total loss and people are then put out. Following on that, we'll talk about the renewals and the importance of risk management. It's very important. All right, the next slide, thank you. All right, so there's a number of headwinds that really that the industry has been experiencing. And actually with that slide, we might just need to click a few, there's a few bubbles. So maybe if you just click a few bubbles, thank you. Yeah, there's a few headwinds. So we're really seeing an increase in the frequency and severity of catastrophes. So, you know, I guess you're all living in, say, southeast Queensland, and you experienced that cat event, that big rain event last year. And, you know, I've lived here all my life, and it was probably the most intense rainfall that I've certainly seen through that, certainly worse than the 2011 floods that we had. Now, if we look at this graph, it basically shows, like, it compares against the climate index. So it's showing like the increased temperatures, obviously, like for the last 15 years. And then we've got a lot more colour. We've got a lot more payouts when it comes to insurance, a lot more events, a lot more wind events, hailstorm events, storm, flooding, bushfire, cyclones, etc. During that period, it was a lot better than those previous periods. Those previous periods, you can see a big green bar in 1999, which was a Sydney hailstorm, and then there was, of course, the black line for the earthquake in Newcastle. So, yeah, we've seen a lot more frequent events than what we have ever seen. And so our pricing has been struggling to keep up to date because, of course, we've got to prepare for those future events. So now also the conversation has moved from climate change, really, to building a more resilient Australia. So we've got to do a lot more risk management, a lot more things to mitigate those exposures so you have less insurance events. Sorry. Next slide, thanks. Okay. So because of that event we had last year, Australia is not seen as attractive to what's called reinsurers. So reinsurance is insurance for insurance companies. So I'm from CHU. The security that I work for, like QBE, actually pays the claims on behalf of CHU. We're an underwriting agency. They're the insurer. Now, what they will do is they will pay a certain amount of the premium to protect themselves from these massive events, because no one insurer can pay for these massive events. So the reinsurance, we're not seen as attractive, and we're paying a lot more than what we did, say, 6 years ago. It was 12.5 cents in the dollar. Now it's about 32 cents in the dollar is the reinsurance cost that QBE actually pays, and of course that's passed on. And we also had Hurricane Ian in the US, so that was like a $60 billion event. So that impacted the reinsurers as well, and so everyone globally is really paying for those increased premiums because of that. Right, we might go to the next slide, thanks. Yep, just click a few times. Awesome. So, yes, you're all familiar that I think, unless you're living under a rock, you'd know that inflation, everyone's paying more at the petrol pump, at the grocery stores, etc. So the inflation figures are around 8%, but really that's a lot less than what we're seeing in construction. So, of course, with construction, we're talking about supply and demand. We haven't had the supply, the materials, many materials. There's been labour shortages, and then we get this massive catastrophe, like the $6 billion rain event. Okay, so that puts even more pressure on demand. You know, we haven't had as much immigration as what we've had previously, so that's certainly impacted on the construction. So that's why we're seeing higher levels. Well, CPI It's higher than it's been since the 1990s. Next slide, thanks. Yep, under insurance and valuations. So that graph I was showing before, really this is the same graph, but it's showing where our building sums insureds are sitting at. So we actually write about half the strata in Australia. So I'm sure that the other half that's with the other insurers would probably be experiencing the same type of sum insured increases. So we're only seeing about 4%. Okay, so they're really not responding to the dramatic inflation. So we think that there's probably an underinsurance exposure to underinsurance for a lot of properties out there when inflation's been in construction's been like 17-18%. Okay, so that means that that leaves customers underinsured. So if we can go to the next graph. Yep. All right. So what's under insurance? It's basically when a sum insured amount on the insurance policy is not enough to cover the total cost of rebuilding, repairing or replacing the building should it be damaged or destroyed. It's a sum insured for your building. It's a maximum amount that the claim would be paid out. Okay, so if you do have a total loss, you would be short. Okay, we might go to the next slide. Yep, the next slide, thanks. Okay. Yeah, and these are main drivers of underinsurance. We've got increased building costs, as we've said, and an increase in catastrophes. So that's what really is driving. It's really driving everything. Okay, so in the event of a major loss or catastrophic event leading to damage or destruction of a building, any shortfall in insurance cover would need to be funded by the owners corporation and unit owners. All right, so you don't want a situation of that because the owners corporation, all the owners would be liable for that shortfall, which could be significant, obviously, if it's underinsured. Okay, the next slide. Okay, now this is the legislation. So it's basically saying that the body corporate must insure for the full replacement value of the common property and the body corporate assets. So there's a requirement to insure for that amount. Okay, so if you're underinsured, you're not complying there. So also it must cover, to the greatest practical extent, damage and the costs incidental to the reinstatement or replacement of insured buildings, including the cost of taking away debris and the fees of architects and other professional advisors, and must provide for the reinstatement of property to its condition when new. So it's got to be more than just the replacement. It needs to factor in things like the removal of debris before rebuilding, fees, architect fees, etc. So the valuation needs to take into account that. Right, we'll go to the next slide. Yeah. So this is an example case study that happened in Perth. So claim date was 2020. The sum insured was 1.2 million, and it was extensively damaged by fire. In 2020, the quotes to reinstate the property were close to the sum insured. And during this time, due to supply chain issue, COVID impacts on labour and the price of materials, the cost to reinstate the building increased. So I guess it was, a fairly accurate amount, but then we had COVID and those increases. And so the sum insured is now insufficient and the owners are left with that shortfall, which they will have to fund themselves. Okay, the next slide. Thanks. Okay, renewals. Okay, yep, next slide. All right, so when you're looking at the renewals, you basically, when you're renewing your insurance with us, you basically have a duty of disclosure under the Insurance Contracts Act. And it basically says you must advise us of any changes to your claims or insurance history that a reasonable person in the circumstances would tell us. Okay, CHU will notify you in writing of any effect a change may have on your insurance renewal. All right, so basically you need to, there's a duty of disclosure, and anything that makes the exposure or the risk worse that a reasonable person in the circumstance would tell us, you need to actually advise of us. So I've put a few examples up here with these pictures. So you can see the first picture has got that aluminium composite paneling. So, you know, you need to disclose all the construction, what the construction is. This is an example, aluminium composite paneling that is a higher fire exposure, and you know, in some circumstances may need to be removed. You might remember the Grenfell Tower in London, the Inferno there. So that's an example of that material. It's actually probably the worst version of it. It is a bit like wrapping your building in petrol, because it does include polyethylene in it. So it's very dangerous. Defects. So really you do need to disclose defects to the insurer. Any maintenance issues that you're aware of or defects should be disclosed. And a tattoo parlour, for example, like deoccupations, any commercial tenants, you do need to disclose to us. And tattoo parlour is probably one I've highlighted because it's an exposure that it's hard. There's not a lot of markets out there for tattoo parlours. For example, CHU does not insure properties that have tattoo parlours in there because of that moral risk, and that they certainly have had fires. Let's just say links to bikie gangs and the like. So CHU certainly stayed away from them. But yeah, there's not a lot of markets out there, so you could have you could find yourself hard to get insurance, or the property could be uninsured because there's a tattoo parlour sitting in there. Okay, we might go to the next slide. Okay, so defects, of course, is a big issue in those maintenance issues. So we really encourage people to tackle them early, be proactive and tackle them early, because really about 90% of declines come from maintenance or defects issues, because insurance does not cover the actual defect or wear and tear, maintenance, etc. What can happen where there can be some coverage, and where we do, but I won't say, I can't talk for everyone. Like insurers, this is the resultant damage that occurs. So if you didn't know about the defect, then we would pick up that resultant damage. But when you do know about the defect and you decide not to repair that defect, and because of that, that's the cause, and it causes that resultant damage, then you would be up for everything. So it's best to get those issues fixed, because they can cause further issues down the track. And once you know about them, you're not going to have the cover for those resultant damages. Okay, so be proactive, tackle early. Definitely work outside of that renewal cycle. Midterm, don't wait for the renewal. Insurers certainly like to see proactive body corporates, and that would be reflective in your claims history then, and therefore the premiums that you will pay. So monitor the building state of repair on a regular basis. Get those inspection reports, have maintenance plans in place. So take more steps more often. Prevention is better than cure, of course. Definitely. Yep. Next slide. Yeah, prevention is definitely better than cure. Certainly a good thing to live by. A proactive OC reduces the risk of claims being denied due to lack of action. Okay. Said before, there is a duty of disclosure with those defects, and the thing is, it's certainly not worth, for example, if you are hiding them. It's probably fairly easy to determine whether there was knowledge that you knew about it. It's always good to get them fixed once you know about it. Also, delays increasing cost of repairs. Yeah, if there's delays, it could increase the cost of repairs. Yep. And of course, the premium increase at renewal. Late or no action places the policy at risk of being declined, and difficulties obtaining multiple quotes. So there's probably not a lot of appetite in the market for buildings with defects as well. We'll certainly, when the renewal is with us, we will certainly work with the insureds to work with you. But there might be conditions put in place, like a shorter term renewal, like a 3 or 6 month renewal with certain conditions to be met, because we're very interested in knowing how the defects and that are progressing. Okay, when people decide they would not act or do anything, that's where it's very hard to get insurance. And slowness to act can be seen as warning bells to insurers, of course, and can suggest poor building maintenance practices. Okay, so we'll go to the next slide. No, we've got some questions there. Look at it. So what can the OCs do? Yep, proactive steps to manage defects, take small steps more often. Prevention is better than cure. Building quality maintain, timely action, deal with aging, wear and tear, full disclosure of claims, defects, works and repairs to the insurer. So you've got that duty not to misrepresent. Okay, so then if you advise us early, we can work with you and that on it. So obtain correct and up-to-date valuations, okay, to ensure that you're meeting that requirement of that the full replacement of that you're obtaining that legal requirement there. You should also consider at renewal indexing, which actually I think that's taking place. I'm sure that's taking place. But monitor your renewal when that comes through, so you can monitor that sum insured. Okay, the next slide. Okay, so premium's often the focus, but owners should probably consider other factors when finding cover that's right for them. So compare the coverage, of course, look at the coverage, the insurer's history, their approach to paying claims. If it's a grey, if you've heard that one insurer is, if it's grey, like the interpretation of it, they generally pay. It's better than another insurer that might fight you. No worries. But I might go to questions.
All right, Craig, we've just got a couple around building sum insured. If an adjuster determines that only 80%, it's only insured to 80% of value, does that mean that only 85% of the claim will be paid?
If it's insured to 80%.
Sorry, 85. They're both 85. Sorry. So
if it's to 85%, well, I guess it's going to be tested when that claim happens, and it is a total loss. But for what you have insured it for, that is a total payout that you'll received.
And so then the next one on the same vein, if a property is underinsured, do the owners receive the sum insured, then make up the shortfall from their own pocket? Or is
yes, they will.
Yeah.
Yeah, they will. They'll be up for it. However, there's also, I believe, a joint and several liability. So if someone goes broke, it could be, let's say there's 10 units. I believe there's someone is goes broke, then it could be like 9 paying for it instead of the 10. Joint and several liability. Yeah.
Then we had, are tattoo parlours still considered the same risk as they used to be? There are so many of them around these days.
Yes, they are. But I guess the insurer might look at it differently if it is let's say it's cosmetic, like I think ladies might do some type of cosmetic tattooing, or I don't know too much about cosmetic tattooing. Sorry, Julie, but I think you'll know the difference between those, the real tattoo parlors like I showed there compared to a beauty.
Yep. So you'd look at the risk.
We will judge, the risk,
and then you make. Then we have, if a property valuation is done, which we know in Queensland legislation, we have that requirement of every 5 years. How often do they need to be updated? 1 year, 3 years, 5 years? And I guess
that's
I would
$1 million
say
question.
In the market we're in, it is. So we're suggesting maybe 3. If we've got something that's 4, they probably need to really consider looking at getting it done now instead of pushing it out the next year.
Yeah, I think generally speaking would be 3.
3.
Yeah, but we're in extraordinary times, so you might want to consider doing it now. Even if it was done 2 years ago.
It's a hard one, but one we all need to look at constantly. Then we have from Byron, if a problem is known about, and I'm guessing we're meaning a defect is known about, and funds are being raised to repair that defect, but an incident occurs before the repairs are able to be completed, will the insurers cover the claim?
Well, it's when you know about the defect, we won't. However, if it's a liability defect, then there's coverage for the liability. So there's not an exclusion on the liability section for it. You know about the staircase, and it falls over as and injures someone, like we would be paying for that.
All right, then, thank you. What happens if we can't find an insurance company to cover our typical precast concrete industrial units? We're down to just one company that will insure us, and they won't even say what we can do to reduce the fire risk.
I think I'd need to. Every situation's different, and really, it's hard to speak of the hypothetical. If it's down to one insurer, it would need to know the circumstances. But I guess if it is down, there'll be a reason why. It could be the tenant that's in there, the high risk tenant. So you can only find the one insurer. So then you've got to decide. Yeah, you might need to look at that tenant.
All right then. I know we've got quite a few more questions, Craig. We might just do a couple more, and then what we'll do is we'll look at them and get some answers to those people offline and answer some of them through our website as well. David did have a question. Your example, 2020, the insured property is 1,245,000. The fire was 2020. Why is the body corporate liable for the extra now?
Well, because it was only insured for the one. I guess too, when deciding the sum insured, the valuer still should take into account what the amount will be at the expiry date of the policy.
Yep. So we've got that full year.
You've only got that to, the sum insured doesn't change, or it doesn't increase with inflation like that. It's up to you at renewal time to increase it. Yeah.
One that I know we always get asked, where does the insurance underwriter stand in regard to risk of fires from EV and e-scooters and charges in car park basements and the difficulty of accessing basements to extinguish these fires in basement car parks?
Wow. I guess where we stand, like it's not for us, we're not asking any questions about electric vehicles, etc. There's no requirements at the moment. I guess it'll be monitored in the future if our underwriting guidelines were to change. I certainly don't see them changing. But the installation of these EV chargers and that we're asking, they need to be done in compliant. Everything needs to, tick the box, be done properly, because that's where you could fall into trouble if, your brother-in-law goes and does it. He's not an electrician or whatever, it needs to be done properly. Is, I guess, my response. It needs to be compliant.
Yes.
But I'm certainly aware of these lithium, the lithium battery fires. We've certainly seen it in a lot of houses and stuff with those scooters. And I know that it takes a lot more to put them out, the fires out with them. But it's something we're going to have to, there'll certainly be a lot of consideration, because we need to have, I think, 100... Queensland, I think, is 2036. All like 100% of sales, I believe, will be EV vehicles. So we've got a lot of work to do. It
is an ever-changing landscape that we'll all keep looking out for. Yes. So I know we've got a few more insurance questions, which we'll take offline and we'll get answered for all those owners, committee members out there. And thank you for asking your questions and having such a great interest. So thank you, Craig, for your presentation.
Okay.
And we'll move on to James. So today we've got James Nickless. James is a partner at Chambers Russell and oversees the firm's Queensland practice. James is an expert in strata title law and litigation, with extensive experience in general commercial litigation, building and construction disputes, debt recovery and insolvency. An experienced negotiator and litigator, James has acted on behalf of bodies corporate, lot owners, builders, developers, banks and other lenders, liquidators, trustees, receivers, public and private companies, as well as government authorities. So I'll hand over to you, James, to complete your presentation, and thank you for joining us today. Shane, if you can just go to the next slide. Thank you.
Thanks, Julie, and Capital, and to Craig as well. Thanks for having me. So sorry about that very long introduction, but I think what that introduction kind of says is that while most of the people out there don't even really know what body corporate is, for those of us that live or work in it, it's a very, very complicated little arrangement. And, in circumstances where things like maintenance responsibilities aren't properly dealt with, or if you've got inherent building defects, then you can end up dealing with a range of different people, including banks, local authorities and liquidators, because these are very significant financial assets that we're dealing with. And when things go wrong, sometimes there's a large amount of money that we're talking about. So if I can go to the next slide. Excellent. So this is kind of what we're talking about when we're talking about maintenance works. And I have a little joke, but it's a very real scenario, which is that I can answer any body corporate legal question with one word, and that word is depends. So everybody wants to be able to kind of look up a code or find the silver bullet for the problem. And the reality is that you end up in a really complex web of, interrelated responsibilities. And so there's a whole bunch of things that we have to think about every time we think about a maintenance issue. And I will give some examples later in my presentation about various things in a building format plan and the standard format plan. But I will give the early caveat to all of that everything has a asterisk depends attached to it, because you can have exclusive use common property where, yes, it's still common property and therefore it's still the body corporate's responsibility, but the exclusive use bylaw may pass certain maintenance or even improvement responsibilities and duties onto the owner that's the beneficiary of that exclusive use arrangement, and sometimes they don't. So before I'm able to give any proper advice to anyone, I've got to review all of the building documents to see if see the way that they've been set up and see what their bylaws say, because a lot of these things are specific to each building. And I've hopefully got some time to talk about some of the horror stories, but in some buildings that, for whatever reason, when the developer's setting them up, they come up with these wonderful ideas that seem so great to the developer that we can develop this scheme in an innovative way. And then you guys as the owners inherit that body corporate with its various foibles. And sometimes the lot boundaries and other things can even not be where you think they would normally be. We've got volumetric lots and other things that kind of change the landscape. So obviously, and this is excluding situations where the parties responsible may actually be outside of the body corporate. So sometimes it's an adjoining landowner, or it's a contractor, or it's some complete third party. But generally, we're going to be looking every time a maintenance issue comes up is, who is responsible for this? Is it going to be a body corporate responsibility? Is it going to be the lot owner's responsibility? That depends. It depends on whether it's a building format plan or a standard format plan. And then obviously the regulation modules and bylaws and everything that kind of govern that. And then once we've worked out whose responsibility it is, we have to make sure that we're within authority to spend that money. We've got to approve it properly. And then we've also got to, sort of more proactive sense, make sure that we're properly budgeting for these things in the event that we're not, that we're able to raise special levies for them. And in circumstances where it may be the owner's responsibility, but you may have, because the body corporate's under a strict liability duty to maintain the common property, they may have rights against others, like lot owners or maybe a builder. But that doesn't mean they can just sit back and wait for that party to make good on their obligations. Sometimes the body corporate needs to go in, fix it, and then recover that amount from a lot owner or a builder or a third party. And then obviously we've got the insurance
James,
consequences. Yeah.
are you able to move your microphone a little closer? It just seems to be dropping in and out a little bit, or there's a bit of echo background noise, and I'm not sure if that's from you or someone else. But
okay,
just see if we can
try. Let's see how we go. Is that any better now?
That seemed a little clearer for me.
Okay, I'll try and keep this a little bit closer to my mouth. Hopefully, I'll try and speak up a little bit too and see if that helps any. So if we could go to the next slide. Okay, so one of the first issues that we want to talk about is whether something, and I've left defects off of this, which we can talk about later, but whether it is maintenance or it's in fact improvement. And obviously that affects the level of authority that the body corporate needs in order to authorise those works. And again, it's not a straightforward issue. So looking through the case law, adjudicators have taken a general view on where the sort of relevant boundary between maintenance and improvement sits. It will be a case-by-case basis, but I think the takeaway point is at least consider it, come up with a reasonable basis for suggesting that it is one or the other, and then act accordingly. I don't think we can live our lives worrying about what sort of may come after some of these line ball calls. I mean, where it's really obvious that something should be treated a particular way, then that might be a bit different. But it is the case that matters go to adjudication, and adjudicators, often come back with decisions that are different to what you would have hoped or thought. The overarching responsibility on behalf of the body corporate is to, act reasonably. And so you really need to just make sure that you've got a sound basis for the particular category you think it falls in. Probably doesn't have to go right to the extent of, a qualified expert, but, this is generally going to be, similar to what was in the common property previously, and, we're maintaining, or this is something that is a complete departure to how the common property was before, and we're putting something, rather than back in its usable condition, we're actually making a substantive improvement. And sometimes improvements, they're not always an addition. So improvement is a concept, and sometimes the improvement is by taking something away. So something existed on common property and you're removing it, that can also be an improvement. And it may also fall into maintenance. So that's probably clear as mud for everyone. If we could move to the next slide. So there's obvious ones, such as, you've got a whole new structure, or you're putting in air conditioning, and that can make it really, really clear that it's like, well, this is clearly an improvement. We've got more subtle, types of issues like a wooden fence being replaced by a colour-bond fence and all those types of things. The other thing that I'll say at this point is whenever you're dealing with maintenance or improvement, there's a whole host of other things that also come off the back of this, and they can have liability consequences and insurance consequences. So air conditioning, for instance, and particularly if you're in a building format plan of subdivision, any time that there are penetrations through the wall, there are risks of internal leaks, and there's also fireproofing issues. So make sure that your bylaws appropriately provide for this. If it's something that the committee can approve, the committee would be well within their rights to seek, information from anyone that's wanting to put air conditioning in or anything else that's going to sort of penetrate the building, to make sure that there's a appropriate expert engaged to make sure that fireproofing and leak issues will be properly dealt with, and you get the Form 15s to make sure that everything's been done properly. Again, as Craig said before, that duty of disclosure to your insurer includes where there have been substantial improvements to common property. So let's say the EV situation before, while there might not be something specific to EVs, if the building was to decide to undertake an EV project and they're going to get EV chargers installed, that's a then significant improvement to the common property or assets of the body corporate, and that's something that should be disclosed. And then whatever comes of that is a discussion between you and your insurer. But in circumstances where, and we've got down there at the bottom, with certain materials that may not be around anymore, so you can't get the same product, that's going to be more likely to be maintenance. Whereas when you're opting for something that's materially better or different, then that's likely to be an improvement. If we can go to the next slide. Okay, so everything that we deal with in the scheme is going to fall into either common property or lot property, and then also we've got a separate sort of class of things, which is body corporate assets. And so sometimes you'll have things that are on a state leasehold, like marina berths and things like that, that might be a body corporate asset instead of common property. But for the most part, and for most schemes, we'll be dealing with common property and lot property. And we've also got utility infrastructure that can be included in common property, and it depends upon where it's located and what it does, how many lots it services as well. If I can go on to the next slide. So this is a interesting one for building format plan of subdivision, which is that it isn't then just as simple as saying, well, is it common property or is it lot property? We've also got these other structural elements that we become responsible for, such as foundational structures, roofing structures, waterproofing wherever it happens to be situated, with the exception of shower recesses, where we've got dividing structures such as parapet walls or balustrades. They all become body corporate responsibility. So you can see how easily it can, that question of depends can become issue in sort of kind of going through these things with a fine-tooth comb, getting the appropriate experts to tell us exactly, is this a load-bearing wall or is it not? For some of the dividing structures, that's a matter of looking at the plan, but certainly for some of the issues such as structural qualities of a particular building element, you might be going down the path of getting an expert to provide an opinion on that. And then obviously, doors, windows and their fittings and those types of things. So A question we often get is, well, that's the window to the lot. Why is that the body corporate's responsibility? And it'll depend where it's situated. If the window is the dividing structure between the lot and the common property, then that's going to be the body corporate's responsibility. Then you can have issues around both window replacement and painting, where some part of the exterior of the building is common property and some part of it is lot property. There's a bit of care to be taken to make sure that we get all of that right. On to the next slide, please. So one of the first ports of call is to have a look at the plan. So generally, we'll have two different types of plans, with the third being volumetric, which are less common, but just as important, and for other reasons can be very important, because they divide airspace. But generally we'll look at, is it a building format plan? Is it a standard format plan? If you're in an older building that was developed under one of the previous acts, you might have a building unit plan or a group titles plan. They essentially mean the same thing as the BFP and the SFP. And so that's the biggest determinant usually in how do you divide up the responsibility between the body corporate and the lot owner is what type of plan it has. With the volumetric format plan, because that's dividing airspace, that can change the rules entirely. I once had a really complicated matter where one of it was a commercial scheme with essentially residential penthouses on top of it in Brisbane, and those residential penthouses were under a volumetric plan. So instead of the usual dividing line being the midpoint of any walls, floors and ceilings, there were actual survey markers that you had to work out by reference to, essentially sea level as to where the volumetric plan began and finished. And in that case, the entirety of the slab was in the volumetric plan. So normally you would say, well, the waterproofing membrane, that's something that the body corporate's got to, be responsible for. And if that's failed, well, then it's body corporate problem. In this circumstance, that membrane, the slab, everything was wholly within the lot. And so that kind of shifted the goalposts as to who was going to be responsible. On to the next slide, please. So these are some kind of simple examples. So the way that these plans are defined, often you can see on the face of the plan itself, towards the bottom, it'll specify whether it is building or standard format plan. But under the Land Titles Act, they define them in a way that essentially, if the lots are separated by building elements, then it'll be a building format plan. If they're separated by survey marks and the building is wholly within that lot, well, then it will be a standard format plan. So if your plan kind of looks like some version of these things, then you've got a building format plan. I'll show you separately standard format plan later, but just quickly, if we look at the example on my screen, it's the one on the right. It's one where we've got a common property balcony, and we've also got the individual lot balconies. So the details on plans really matter. Where you've got the thick black lines, they're a boundary. Where you've got the slightly lighter, thinner lines, that just designates that the balcony begins and ends at that point, and the rest of the lot begins. So lot 2 and 3, there is no sort of boundary, no sort of legal boundary between the balcony and part 2 of that lot. Important to be able to properly read the plans or get experts who can properly read those plans, because you often get issues around balconies where people won't fully understand where the true boundary is and who's responsible for various things. If I can go to the next slide. Yeah, so that was just an explanation of the plan which I'd sort of given. So on to the next slide. I guess the important element from this is that for a building format plan, generally, it will be that midpoint of that building element. So the wall, floor or ceiling, which will be the dividing point between lots and other lots and lots in common property, with the exception being where that building element is the boundary between the lot and common property. The whole of that building element will be body corporate responsibility. So the whole of the balustrade, not half of the balustrade. On to the next slide. Next slide. Okay, so these are for looking at utility infrastructure and where the sort of boundaries for that may be. Now, if we look at an example where the utility infrastructure is serving one lot only, then that will be that piece of the utility infrastructure will be the owner's responsibility. And where it is going to be servicing more than one lot, then it will remain the body corporate's responsibility. So if we look to the utility infrastructure sort of plan on the right, we can see from the left that the boundary is that midpoint between those walls. We've got utility services that are going through the middle of those walls, and where you've got that trunk infrastructure in red that's servicing multiple lots, that's the body corporate's responsibility. Where you've got something that's actually entering the lot, so we've got there with the sink, and we've got it again with the toilet and the shower. The blue elements will be the lot owner's responsibility. The red elements will be the body corporate's responsibility. So often, particularly when it comes to a burst pipe, often you'll have the just get it fixed scenario of get a plumber in as soon as possible and stop water from penetrating into this lot. It's also equally important to make sure that that plumber does a report on what the actual element was that failed. Did something go wrong in one of the blue elements, or was it caused by something in one of the red elements? And then that will help determine whose responsibility the actual repair and maybe some of the resultant damage belongs to. On to the next slide. Okay, some horror stories. So I'll go through a couple and then I might sort of open up to questions. But some of the horror stories I've seen over the years include a garbage chute, which was not sort of properly installed in the beginning and wasn't kind of installed with the correct leveling, which caused certain items to kind of remain in the garbage chute, and they would get lodged there, and then other things would build up and it would get horribly smelly and didn't function properly. The manual for the maintenance of the garbage chute called for a flush of the garbage chute, and so the resident manager dutifully and in accordance with the manual, undertook a flush of the garbage chute. I don't know if some of you are in buildings that have garbage chutes, but we've got that generally, that metal sort of handle in the metal, almost like the letterbox type mechanism. You put your garbage in and you close it up and it goes down the chute. Because of the problems that this garbage chute had on installation, when the flush took place, what actually happened was the water rushing down hit those metal sort of bins, for want of a better term, opened them outwards, and disgusting water went through all of the common property hallways. That matter ended up needing a $500,000 refurbishment to the garbage chute, and that was attached to a plan that the Brisbane City Council had to sign off on, pardon me, because there was a waste management plan for that building. So sometimes these things can be really discrete issues that can be easily dealt with, sometimes not, and sometimes you've got, in certainly more modern buildings, a lot more potential complications, such as any sort of waste removal contracts that you have in place or waste management plans you may have with the local authority. Another really bad one that I had was a building that was constructed in a really strange way. Essentially, it was a retirement village that had been set up under a corporate structure. Each owner owned a lot which was divided into 2 living units. And for whatever reason, the original developer built the units up on stilts and then later came back with earth moving equipment and banked up the soil so that when you walked around the scheme land, it looked as though the entry to the units was on ground level. In fact, that had been done post-construction, and there were these voids under the subfloor. And what had happened over time was that water had got in under there. As anywhere water gets into, there was mold issues. Mold was coming up through the floor. It was making these units uninhabitable. And you also had older and residents in there that had respiratory illnesses and all sorts of things. So council got involved in that one. It was ended up being quite a disaster. And because of the way that it had been set up, it was a situation where there was this subfloor under the actual lot, and therefore that became the body corporate's responsibility. Whereas if that was something that was happening within the lot, then that would have been the owner's responsibility. Years later, I found out that they had actually excavated some of the soil away, put bruise blocks in. They had a mechanical ventilation system put in. There was a lot of money spent, but the body corporate did actually eventually get this back to being in a livable condition. But there can be circumstances where some of these issues can get so bad that people can't actually, live in the units. Or one that I've got at the moment where the testing on the balustrading has come back such that we've had to issue urgent warnings to anyone who enters upon scheme land not to put any lateral pressure against the balustrades while they are urgently undertaking the necessary rectification work. So some of these things seem sort of finicky and annoying. Some of them can actually be life-threatening, as we see in the case of some of the combustible cladding. I had a particular horror story with that where early on in the cladding identification process, there was a building that had been really diligent, and they decided before the QBCC or anyone had told them to do anything about it, they decided they were going to replace their non-conforming cladding. And then unfortunately the material which the architect had specified for them to replace it with was also non-conforming. So they went to all this expense of replacing the cladding on their building only to find that what they'd replaced it with also wouldn't fit the bill. I've also had instances in the original construction of a building where we were acting for a developer many moons ago, and they had 2 builders go insolvent whilst they were developing that building. So it doesn't say much for what the future of that building is going to look like when you've had someone come in to essentially save the project from one insolvent builder, and they themselves ended up becoming insolvent as well, which can really lead to some complications for the building's ability to get recompense if there's inherent defects, and just generally the separation of the different builders meant that there were certain things that the new builder wasn't going to want. They eventually went insolvent themselves anyway. Why do I bring that up other than, to be within the horror theme of this part? It's because at the moment we're seeing a lot of insolvency in the construction sector. So that's not just on new builds. If you've got companies coming in that are doing works to common property, make sure you look at those contracts carefully. Make sure you've got contingencies in place for what if this building company isn't here tomorrow? Are we going to be okay? So I will stop the main part of the presentation now because I think I've walked on for probably long enough, but if I haven't, I'm sure we'll hear about other questions and I'll try to deal with those questions separately.
All right. Thank you, James. That was awesome. And like I said before, we've had a couple of people that said they need to leave, but the recording will be made available. There's a couple that might be just quick one-word answers. If the handrail is on the front veranda of the lot facing a common area, which I would assume they mean common property, who'd be responsible for that? Body corporate, because it's on the lot of the boundary lot.
Yep. And that'll depend also if it's a standard format plan or building format plan. But if it was building format plan, then yeah, that's going to be the body corporate's responsibility.
And once again, it will be dependent on a BFP or your standard format plan. Is a security screen on an external door part of the body corporate responsibility? We all know this can be a tricky one because we don't know when they were installed or who installed them.
Yeah, that can be an issue. So essentially, I think the starting position is you'd be saying that security screen would be part, if it's a building format plan, you'd be starting from a position of saying it would be. If the body corporate records kind of showed that that was something that was put in after the fact, then it wouldn't be. So with all of these sort of boundary structures, if a lot owner, and with all improvements, if a lot owner makes improvements, then the general rule is the lot owner is responsible for those improvements. The body corporate doesn't inherit responsibility for those improvements.
What is a reasonable time frame for a body corporate to investigate and repair a roof leak which has caused internal damage to a unit? Another one we know is a tricky one that there's no right or wrong time frame or answer to.
No, there is no right or wrong for that. I guess what I would be saying is that things like that which cause resultant damage, if we look at the Moroccan case, that was a situation where there was no waterproof membrane originally installed by the builder or developer. The body corporate is responsible for that, even though it isn't in existence. So the court said that means put one in if one isn't there. And so what happened in that case was water penetrated into a commercial lot, which was a Prada store, and a whole bunch of things got damaged. And the body corporate was up for the repair, they were up for the resultant damage, and they were up for the legal costs on both sides. So anything that can lead to further damage, you want to try and deal with it as soon as possible, because the body corporate becomes responsible for that resultant damage. Also, I guess if an insurer is involved, and as Craig had said before, if you become aware of a problem and then you sit around and don't do anything in relation to that, well, then the insurer may be able to avoid coverage. So reasonable time as soon as possible. And I know that doesn't help hugely, but just don't delay. The legal sort of definition of that duty is strict liability. So that means an element fails, you are immediately responsible for it. In other areas of the law, like negligence, you have a reasonability element to it. With strict liability, you don't have any reasonability element. You can't say, oh, look, we couldn't get it done because we couldn't find a contractor or whatever. The court will just simply say, it's a strict duty, it failed, somebody suffered loss and damage, you're responsible.
Which is a good point, coming back to your balustrade example before, and when we tie our insurance in, once we're aware of these issues, we need to keep our insurer informed. Don't just, as your body corporate, go off and do all this work. Just make sure you're keeping your insurer informed. Let them know there is a problem, how it's being addressed, and we can work together with the insurer, and they can come back to us if they've got any recommendations or action they want us to take as well. If we look at a standard format plan, if an owner does not do maintenance on their roof, does the body corporate have the ability to do preventative maintenance on those roofs?
Theoretically, yes. So just because something's the owner's responsibility doesn't mean the body corporate can't do anything in relation to it. So much in the same way that the body corporate has an obligation to maintain common property, the owners have an obligation to maintain their lots. If, for instance, an owner doesn't paint or they don't repair their roof, the body corporate can put them on notice that it's requiring them to do that under the legislation. And if they don't do it, then the body corporate can undertake those repairs, and they can charge the amount back to the lot owner as a debt. Having said that, very few bodies corporate do it. I don't know why, other than perhaps they don't want to sort of impose on the lot owner. But in circumstances where, say, the lot owner's inability or refusal to do something is adversely affecting other lots, then usually the body corporate will kind of step in. So in a standard format plan situation, it'd be rather strange because the person who is suffering the loss is in fact the lot owner themselves. So the body corporate sort of desire to get involved in that might be a lot less. In a building format plan situation where it might be, well, I mean, that would be different for a roof because that'll be the body corporate's responsibility. But let's say it's something within the lot, a tap, a shower recess or something like that, that is the lot owner's responsibility. That right can also be used, and often is, because it might then be going down through into another lot. But theoretically, yes, the body corporate can do something about it. Don't do it willy-nilly. Make sure you get your ducks in a row. There's a statutory requirement to provide at least 7 days written notice before entering a lot. So there's a lot to consider, but theoretically, yes, they can do something about it.
Now, I know we've got a couple more questions which we'll answer offline, but I have one question which I'm going to ask, which just to tie both subjects together, and I have had a couple raise it with myself and in our office. With the increases we're seeing in insurance, where we've got equal contribution schedule entitlements and the insurance forms the component of the administrative fund levy. James, have you had any experiences or people asking the question, would it be better for us to pull our insurance and strike it as a special levy or a separate levy to our admin and sinking fund, trying to ease the pain or make it easier for owners? They might be at different periods. And what should we do? Like, I know we're going to have to go to general meetings to approve it but have you had any of schemes come to you with that type of question?
I haven't had them come with that type of question. I've had schemes that have looked at self-insurance, which is a very sort of scary proposition. And I've had schemes look at the proactive measures that they can take to reduce their insurance, which I think is a really good thing for them to look at. It means a bit of cost at the beginning that can deliver some benefits down the track. But generally, when it comes to like the sort of budgeting, I would have thought that it wouldn't really. I'm just trying to get my head around the question in terms of what would be the benefit to having it sort of structured in a different way from a fund point of view. I would think that I'm just struggling to see how that would be of any benefit. I mean, you've got to pay your levies in any event, regardless of what they sort of comprise of. Insurance has got to be paid by a certain date, so the body corporate's got to have the money by that date in order to pay the insurance. So I might be misinterpreting the question, but no, I haven't come across that particular issue.
I think it's probably, like you said, more budgeting, trying to ease the pressure for the owner. But like you said, they've still got to pay the levy. The body corporate needs to raise the insurance, whether it's encapsulated in that administrative fund or taken out. But if we're going to take it out, we'd have to look at the levies that have already been approved and at your general meeting approving a separate levy, which I guess creates those complications then when owners vote no and a fund fails, that you've got to go back to another general meeting to strike and raise your levy.
Yeah, so I mean, your sinking fund levy is meant to be for things that are of a capital nature that, essentially aren't regular payments, and your admin levies are meant to be for things that are sort of regular and repeated and
recurrent.
you kind of know about. So you can also then start to get into technical issues about whether you're commingling funds from admin to sinking, which you're not supposed to do either. I have had schemes look at borrowing for insurance, which is another sort of way that they can deal with things if they haven't got the funds. Maybe that's a path to look down body corporate borrowing. Obviously, they've then got the interest rate on the loan. But I think if it was down to the wire and you were going to have no insurance, then that would be something that you'd probably seriously consider.
Craig, have you seen many premium funding for insurance in the last couple of years following COVID and these increases? I know the option is there with some insurers or body corporate loans, but have you been exposed? You're on mute.
Craig.
I don't know anything specific to Strata, but premium funding happens all the time with insurance through insurance brokers for many different forms of insurance. So it'll always be available to you. Yeah, it's a big business actually.
Yeah.
Premium funding.
And then, like James said, there is the option of body corporate loan, but once again, you've still got the owners still have to pay. So one way or the other, they're paying. Unfortunately.
Yep.
That's easy. And another one, if an owner is tired of waiting for the body corporate to fix a roof leak from the 2022 storms, can the owner arrange the repair and then claim the cost back from the body corporate? Once again, I guess we need to look at it as a building format plan or that standard format plan, what the insurer, where the claim is at with the insurer, and getting some advice from that insurer.
Yeah, that's right. And I mean, there's also issues there. So on the one hand, there's the lot owner sort of taking the opportunity to mitigate their further damage by saying, I'm going to undertake certain works that will stop this damage from occurring. And there is a process under the BCCMA where, provided the sort of amount of the works that an owner may have paid for is less than $10,000, or if the works that they're requiring the body corporate to do are less than $70,000, then they can go off via the adjudication process to enforce that. If we're talking about a lot more than that, then we'd be sort of outside of that particular jurisdiction. But I would probably be looking at trying to at least get the coverage of an adjudication order, particularly in circumstances where what you might be doing works to is an element of common property, in which case the lot owner cannot do works to common property without body corporate approval. So a bit of a catch-22 there, but I think I'd probably start with raising a motion to the committee in the first instance, then a motion to the general meeting for the repair of that building element, and then off to the Commissioner's office. If it's absolutely desperate, you might look at getting some make-safe works done, knowing that there is some risk at the end of all of that, that you might not recover everything without having to go off to court.
Thanks, James. And I do see that we're at 11:43 and a few people are leaving, and we probably do need to wrap up. So I'd just like to say thank you to Craig and thank you to James for your valuable insights today. Like I said before, we will have the recording available. We will go through the other questions that we haven't been able to answer live and get those answers to the owners so that they've got those and some clarity for them. And would like to thank you all for coming along. Once again, don't forget to provide your feedback, and that you do have the opportunity to win that $100 Visa prepaid card. So thank you all. The recording will be out soon, and we look forward to seeing you at our next webinar. And once again, thank you to James and Craig for giving up your time.
Thank you, Julie. Thank you, everyone.
Thanks, Julie.